Kelly Smith. Welcome to our Revenue Projection and Proforma Creation module. We're going to walk through the important steps of creating projections as well as your expense management. And in order to do that, the main diagnostic tools you'll need to complete so that we can create your proformas are your practice diagnostic monthly revenue worksheet, benchmarking report, and if you'd like to send in your detailed profit and loss, I'm happy to put that in and do the analysis. So why do we do this and where do we start? Unless we look at the numbers and understand what we're trying to do, it's very hard to create necessary growth or even to know where to start. So the first step is really looking at what have you been doing so far. So we're going to start with revenue to date this year, your monthly averages. We need to look at that for the last 2 years, and I'm going to take that down to looking by service, by procedure. So we'll break that down and I'll show you what it looks like, but essentially lasers, face surgical, body surgical, injectables, retail, ancillary services. We need to know what your mix of revenue is. And that's going to be what we start with. So we need to identify what are your profit centers, what are your average monthly sales by area, and we'll get down to what your average pricing structure is, and that'll give us an idea of how many services you're doing on a monthly or weekly basis. That's really the very first step that has to happen so that we have some information to analyze. So if we're building something to start up, if you're just starting, we'll build those numbers up in a way that we know we can sustain that based on the marketing budget and the staff you have. Or if you're already in business and you want to take it to the next level, we really need to see what's been happening first. Then we need to discuss where the profit is and what you like doing. Many times you might be doing a lot of something you don't like that's not profitable, so we need to change that and we need to figure out where's the revenue going to come from. So there's really several reasons of going through this step. Number one, we need to know where we're starting from. We need a benchmark. Then we can set clear goals and we can make decisions. So the key areas of expenses that we're going to look at are cost of goods. How much retail do you have to buy to support the sales you want? How much injectables? What are the costs? What does it cost on a general rule of your marketing dollars if you're trying to create $30, $50, $100, $200,000 a month? It's a very different conversation. So if a med spa or a plastic, if you're at 800,000 or you're at 4 million, we're going to be talking about very different things. And so the first step is I have to understand where you're starting from, and then we can look at where you're trying to go and how long it's going to take to get there with what kind of budget. So we start really simple. Let's identify the services that you have or that you're going to add and look at the services that you may want to stop doing. And then the next thing is we really need to understand what the average price is for that service or series as well as the cost to do that. Then once we identify that, if we're projecting, we need to double check that it makes sense that we can get that many, those numbers of services per week or per month. If you're starting up and we're doing a marketing budget, I always like to look back at, does it make sense with $3,000 a month marketing that we could get, 6 injectable appointments as a weekly average, 4 retail sales, 9 lasers, 2 body corners? Yeah, it does. I think we could do that, right? So putting the numbers from the top down is great, but we also have to look like this from the bottom up. How many services would we actually have to do that? Do we have the staff to do it? Because if we just throw out numbers from a top-down revenue, everyone wants more money and more services, whether they have the staff to do it or the time. So we really need to look at it as a whole. And then the mix of ratio is important because a lot of plastics don't want to be making all their money from surgery. They can't take a vacation. There's no sales happening when they're not in town. They want to build ancillary services, but 90% of their money is coming from surgery. Okay, then what do we do to build the ancillaries, the non-surgical, so that you have that freedom and you're building the practice and you're creating a value so you can sell it so it looks good on paper? That's when this ratio becomes critical. So if we're talking about for a healthy business, you really do need 10% retail sales, you need a certain percentage of surgery and ancillary. Once you see all of that laid out, then you're going to understand where you want to take this. So it's a decision-making tool. Without the information, it's very hard to create a strategy. Typically, we want to forecast out 5 years with a decent percentage growth that we can make sense of based on services, marketing budget, staffing, providers, all of it adds up together. We can't just grow magically for no reason. So in summary, we are going to have to identify what new services, providers, or marketing dollars are going to create the growth that you're looking for. There's a lot of different ways to do it. We can talk about, internet and pay-per-click, referral sites, your website, other print and traditional medias to create the growth you're looking for, and really getting into what those conversion ratios are by area, because a lot of those different billboards are going to convert differently than pay-per-click, as an example. So we always want to start from the highest and most effective, the cheapest way to do it. And then once you just have so much money and you want to spend it, then we'll add on the other fun things. But if you're not doing a pay-per-click budget, then please don't buy a billboard. Let's go in the level of hierarchy that's going to create the result you're looking for. So in order to do that, what do we need to do? We need to know what the return on investment is for your current marketing dollars, so that we can decide what you should keep doing. And that's what the leads benchmarking form is for. It's going to ask number of leads coming through your internet, how many leads you're getting from radio, how many leads you're getting from whatever those referral sources are. If you're doing radio and you're doing pay-per-click and you're just doing SEO on your website, maybe you're doing real self, every single one of those, we need to look at what, on average, the number of leads you get against what you're spending. And then we're also going to pull that through to revenue if we can. And that's really going to help us decide what's going on. Now, even if you don't track it from lead to revenue, we can still extrapolate backwards what that ratio is. As long as we know on average the number of leads coming in, the number of consults, and the number of procedures, we can then take the ratio of leads that came in through those different types of lead sources and get an idea. But the main thing is we want to look at number of dollars spent and leads generated, and that needs to fall between that 100 and 300 range. And then if we can look at revenue and extrapolate that if we need to see if we're really getting that 4 times effect, 400%. Because that means that your cost is 25%. And we know that, if you look at your overhead and your net profit and just the cost that you cannot control, if you're not getting more than a 400% return on investment for marketing, you're just working harder, not smarter. There's not any money coming out the bottom line or into your bank account. You're just working to stay at a break even and no profit. So you're just staying busy and not making more money. That being said, as we look at this, we're going to look at it in the different ratio segments by service so that we can benchmark it. That's important because moving forward, if we start tweaking and changing things, we want to be able to see the growth and the changes. And that really brings us to setting clear monthly goals and how do we achieve them. And that's through weekly updating of your status. So whenever you measure performance, it improves. That's like Business 101 from 1996, you know that if you're measuring it, it's going to get better. So if that's the case, we want to set the goal and we want to measure it weekly, even if it's just the owners and the management group. If you're not comfortable with the staff knowing it, then that's fine too. But many times I talk to doctors who really don't know what they do revenue-wise in a year or on average per month. The very first thing we need to know is that. And if you decide that you want to bonus the staff over goal, I suggest a 1% per staff member for over goal. So for every 10,000 the practice is over, each staff member makes an extra $100 that month. 10 staff members, it's a 10% cost. Measuring is important, but some areas less often than others. So we want to look at your profit and loss quarterly. We want to look at your annual goals quarterly. But when we talk about expenses, we can measure them monthly, but we want to try to improve them and look for improvements quarterly. And then with revenue performance, we do need to benchmark it every single week and reward the staff monthly. If you go too far out from that, you've got the carrot too far away and they forget what they're doing. If you're running a restaurant, you have to do a nightly sales goal. You can't even go a week. So consider yourself lucky. Failing to plan is planning to fail. So let's put it all together. What are we going to measure on a weekly basis? how are we going to control expenses, where can we cost cut quarterly, and how can we bonus our staff on sales and maybe even reward our managers on cost savings. That's a higher level, more advanced technique, but it does work really well. The key here is don't get fixated on the dollar amount that you spend per month. It really needs to be looked at as a percent of income. And traditionally, when you look at expense management, you're going to review any cost that's higher than 1% of income. You'll see a lot of things are less than that. You can also look at fixed costs that you can't control, and perhaps you don't want to pay too much time on that. But when we're looking at cost of goods and payroll and marketing, those kinds of things we do need to look at as a percent of income because we can benchmark that over the years. We can look at it from 5 years ago, 4 years, 3 years, and if it's going up or down, and what that relationship has to do with the rest of the performance. So those are key metrics that we want to keep an eye on. With expenses, you'll see that there are averages that really do apply to almost any size. Practice. So labor costs tend to be around 25%. Marketing costs between 5 and 20%. The rent should be 5% or less. A lot of times it's higher. Owner's draw is great to set as a percentage so that you have something motivating you as well instead of I need $20,000 a month, so I take it, whether the facility can handle it or not. That's kind of a recipe for a disaster. But if you're entitled to a certain percentage of income, you're going to work harder to create that income growth that you're looking for. Just like motivating your team with a break-even bonus structure, we can do that right down to the owner level. Some of the things that are missing occasionally, retail employee commission, that is an expectation by most employees in this industry. Your average retail sale should be somewhere around $250. Most of our products are right around there. And then retail as a percent of income for your total practice, if it's not 10%, we need to figure out how to get that there. Some other minimizing costs things to consider on your checklist is how often you're ordering inventory, whether you're reconciling inventory and keeping track of that, looking at what your cost per procedure, what that is and where you can tweak those things, especially for the services that you're doing more of. It's kind of the 80-20 rule. So if 80% of your revenue is coming from these 6 procedures, let's start there and analyze them and make sure that we're not spending too much money in them because that's got an exponential return on it. Then looking at retail reports. If you've got a lot of retail, we want to look at top down, what are your top 20 sellers? What should we take off the list and not carry? And make sure that we're not duplicating because that will cause your sales to go down and confuse your staff. Vendor choices, you might want to put all your apples in one basket. You can drive your rebates up and your costs down. Sometimes you can create better terms for how you're paying instead of per order. You can get net 90, you can get other terms set up, net 30, not pay upon delivery. And we need to look at how you're ordering. Are you ordering far enough apart to get the quantity discounts and all the rebates that you need? So these are all things that you can quickly assess when you start looking at these numbers. And as far as back bar, if you're doing a lot of ancillary and aesthetics, you really do need to look at this separate from surgical. You'll see that, especially if you're doing a lot of high-end facials, sometimes you're paying the client to come in and see you. So you need to look at this and measure how much needs to be done and systemize that with the staff so everyone knows. And many times I feel like to drive this cost down, rewarding the manager of this department with cost savings by percentages, how every percent saved, tying that to a bonus for them is one of the best ways to get them to get some skin in the game. Pricing strategies and checklists, we want to talk about package pricing. Typically, buy 2, get half off the third, buy 5, get the 6 free. That's 20%-ish. We don't want to go deeper than that. You do need to incentivize your patients to buy the package up front, but that expectation is about a 20% savings. When we talk about cross-promotion or value-added instead of discounting, that's what we're suggesting in that annual marketing plan that you've probably already completed, and that's going to start reaping benefits. You'll start seeing the changes of that, 90 days or farther out because it's an expense savings, which takes longer to see. As far as looking at other areas, the per-service profit analysis will definitely help in this area, as well as selecting the services you want to promote based on where your net profit is and what you like doing the best. Lastly, utilizing vendors, which is a whole topic on its own. We can get into that. There's a lot of different ways to utilize your vendors to get your costs down. But at the end of the day, it's all You do the math. Run the reports, do the analysis. That is what it takes to figure out where the opportunities are for your practice to save money. So what we need from you is that PGC practice diagnostic. We need the revenue worksheet, the benchmarking, and that profit and loss if you want. And then what you'll get back from us will be all these detailed reports. We'll be able to give you your revenue by service worksheet down to monthly and weekly goals by number of appointments. We'll look at how you're doing in the financial areas and where you can improve, as well as the operations. Each one of these areas is really going to identify what are the key top 3 things we can help you do so that you become more profitable as a company. And as we move down to these benchmarking reports and lead reports, when you're trying to fill them out, if you run into trouble, let us know. We can walk you through how to create these. We often can back into them from systems that you don't realize you've got, but you can get these numbers even though you may not be aware of it right now. And it's important to look at them based on trends, not exacts. None of it's perfect, but if we can identify the trend and use it as a benchmark, we know where you're starting from in order to tell if we're improving things. And that's really important. So if we can get those from you, we will then give you your revenue projections, an expense budget, your appointment averages, a 5-year growth projection, and your benchmarking reports. And then quarterly, we can meet and go over that information with you, but even better, setting goals of where you want to be. So as we get through all of this material, I'm sure that selecting your next module will become even clearer, but this is a great step in the right direction of understanding the fiscal health of your business on a level that not even your CPA understands. Thanks.